In recent days, an unusual trend has been unfolding beneath the surface of the precious metals market. While price movements provide a glimpse into the dynamic, the full picture emerges only when considering the context, the pace at which market expectations have shifted, how these moves affected different sectors, and the interconnected responses across the market. Such shifts seldom occur in isolation. They often result from multiple underlying pressures accumulating gradually before intensifying within a short time frame. Take silver, for instance. It hasn't merely risen incrementally. Instead, available market data reveals it surpassed long-established resistance levels with palpable momentum. This shift compelled traders, analysts, and procurement strategists to reevaluate their positions. Similarly, gold advanced to levels that earlier in the year would have been regarded as temporary. The combined moves point to a broader revaluation of uncertainty rather than a straightforward speculative spike. When sudden movements like these happen, the instinct is often to pinpoint a single cause, be it inflation expectations, geopolitical tensions, technical indicators, algorithmic trading, or speculative activity. However, in reality, sustained trends typically stem from an interplay of several converging factors. It's not about identifying a sole driver, but understanding the interactions among diverse influences. One predominant dynamic during this period has been the intersection of rising political tensions and shifting monetary policy expectations. Public disputes between political leaders and central banks are not unprecedented, but as these disagreements become more pronounced and visible, markets are forced to reassess assumptions about policy stability. The debate, though often framed as procedural or administrative, hints at deeper concerns, such as questions surrounding monetary leadership's credibility. For markets, the nuances of legal matters are generally secondary to the broader implications of such tensions. When central bank independence appears compromised in public discussions, investor focus shifts from immediate policy announcements to long-term credibility, a fundamental factor shaping asset allocation strategies. Periods of political uncertainty are often linked with heightened interest in hard assets like gold and silver. Reduced interest rates, if realized, make these non-yielding assets more attractive by lowering their opportunity costs. Additionally, ambiguity in policy direction makes assets perceived as neutral to political interference more appealing. Alongside monetary debates, geopolitical risks remained prominent during this period. Developments across multiple regions have fueled uncertainties surrounding trade routes, energy markets, and diplomatic relations. Even without outright conflict, sustained tensions typically prompt a shift in risk management strategies. Historical data shows that during such times, capital gravitates toward instruments that are liquid, globally recognized, and less susceptible to localized disruptions. Gold has long been a go-to option for this defensive positioning. Silver, however, occupies a more nuanced role. While it acts as a monetary hedge during periods of economic uncertainty, it also serves as a vital industrial material during times of technological or economic transformation. This dual identity increases its potential for volatility. Price movements can escalate rapidly when both investment demand and industrial requirements align. Another factor influencing recent discussions has been policies related to critical minerals. Public statements suggest that trade measures remain under evaluation rather than conclusively applied. Silver's classification as a critical mineral in the United States has reframed perceptions among policymakers, manufacturers, and investors regarding its importance. Even when specific trade restrictions aren't immediately implemented, the designation signals long-term concerns about supply security. Such policy directions often cause ripple effects across markets, leading downstream users to adjust procurement strategies by diversifying suppliers, bolstering inventories, or securing extended contracts. These shifts might not immediately reflect in headline figures, but can reshape demand dynamics over time. That said, alternative interpretations should also be considered. This type of market behavior is rarely confined to one explanatory narrative, but instead shaped by a convergence of many factors, weaving a complex and evolving backdrop. Understanding these overlapping influences provides a more holistic view amid uncertainty. Some analysts argue that policy delays reduced near-term pressure and that price movements during this period were primarily driven by speculative positioning rather than structural demand. From that perspective, breakouts may reflect crowded trades rather than durable shifts. History offers examples of both outcomes, which is why caution remains warranted. One area receiving increased attention has been the distinction between paper exposure and physical demand. Futures markets and derivatives provide liquidity and price discovery, but physical delivery reflects a different set of priorities based on commentary from market participants and available delivery data. There has been discussion about an increase in entities choosing to take delivery rather than roll positions forward. If accurate, this behavior can tighten nearby supply conditions, even without changes in overall production. That said, delivery statistics can be interpreted in multiple ways. Some increases reflect routine hedging or inventory management rather than directional conviction. Others may be influenced by logistical timing or regulatory considerations. Still, when delivery interest broadens beyond traditional participants, it becomes a variable worth monitoring rather than dismissing. The focus on physical availability has shifted the conversation away from abstract debates and toward practical questions. Who needs the metal? For what purpose? And under what time frame? Industrial users are typically less sensitive to short-term price fluctuations than investors, particularly when the metal is a small but essential component of a larger production process. Their behavior can therefore stabilize or destabilize markets depending on circumstances. From a price mechanics standpoint, the movement through widely observed levels tends to trigger secondary effects. Short positions may be reduced, momentum strategies may activate, and options positioning can adjust rapidly. These flows do not create demand on their own, but they can accelerate price changes once a threshold is crossed. Whether such moves persist depends on what follows after the initial adjustment. This is where durability becomes the central question. Breakouts that occur in isolation often retrace once positioning normalizes. Breakouts that occur alongside macro uncertainty, policy shifts, and potential supply considerations can behave differently, though not without volatility. Pullbacks, when they occur, are often part of the process by which markets test new reference ranges. Risk remains an essential part of the discussion. Silver has a history of sharp corrections, sometimes without clear warning. Volatility cuts both ways, and leverage can amplify both advances and declines. The presence of supportive factors does not eliminate the possibility of rapid reversals, particularly if sentiment shifts or alternative assets regain favor. What differentiates this period is not a single headline, but the convergence of themes, political uncertainty intersecting with monetary expectations, ongoing geopolitical tension, evolving policy language around critical materials, and renewed focus on physical demand behavior. Each factor alone might not have produced the same outcome, but together they create a backdrop in which price sensitivity increases. Understanding that backdrop does not require assuming extreme scenarios. It requires recognizing that markets are adaptive systems. They respond to changes in expectations, incentives, and constraints often before those changes become fully visible in official data. Observing how different participants respond provides clues about what the market is attempting to price in, even if the final outcome remains uncertain. As attention continues to build around silver's recent levels, the interaction between speculative interest, industrial requirements, and policy signaling becomes increasingly relevant. The balance between these forces is not static, and shifts can occur quickly. How that balance evolves will depend on whether underlying conditions reinforce current behavior or begin to diverge, particularly as participants reassess positioning in light of recent price action in the broader macro environment. Observing volume patterns, open interest in futures, and settlement behavior provides context for understanding which pressures are temporary and which may be more structural. For instance, when large participants consistently opt for physical delivery, it signals a different kind of engagement than rolling contracts or speculative hedging. That behavior has the potential to tighten near-term supply without necessarily altering long-term fundamentals, creating localized volatility spikes that can persist until the market digests them. Another element at play is the interaction between industrial demand and investment flows. Unlike gold, silver straddles both roles simultaneously. Industrial demand often responds to anticipated production needs, technological shifts, and infrastructure requirements, whereas investment demand responds more directly to perceptions of risk, monetary policy, and safe haven considerations. When these two forces converge, the resulting market dynamics are amplified. Midweek retracements, for example, can reveal whether industrial participants are using price pullbacks to secure supply, or if they are remaining on the sidelines while investors drive the short-term swings. Currency considerations add another layer of complexity. Silver's price is often referenced in US dollars, and shifts in exchange rates can either accentuate or dampen movements in domestic and foreign markets. When the dollar experiences weakness, metals priced in dollars tend to benefit. But it's not a simple inverse correlation. It is influenced by relative rates of change, expectations of central bank policy abroad, and the timing of large flows between physical markets and futures positions. Each of these variables interacts with price action in a way that can either reinforce momentum or create sudden reversals. Geopolitical flashpoints continue to feed uncertainty, particularly in regions critical to metal supply chains. Even when headlines are managed and military action does not materialize, the perception of risk triggers behavior across multiple market segments. Procurement managers, hedgers, and traders alike may respond to signals that supply could be disrupted, adjusting inventory levels and hedging strategies. This reactive behavior can temporarily increase demand in physical markets, further supporting price levels beyond purely speculative factors. The structure of futures markets itself also contributes to the current environment. Options and margin positions amplify price responses to sudden movements, but they also act as pressure valves. When volatility rises, positions can be forced to adjust. sometimes exaggerating short-term swings. However, if underlying demand remains strong, these adjustments serve more as acceleration mechanisms rather than reversal triggers. Observing which positions are being rolled, delivered, or closed can therefore provide insight into whether a move is a transient spike or part of a more durable shift. Supply-side dynamics are equally influential. Silver is mined as a byproduct in many regions, meaning output is often tied to the economics of other metals. When industrial metals experience rising demand or geopolitical restrictions on production, silver output may not respond immediately to price signals. This structural characteristic introduces asymmetry. Strong demand can coincide with relatively inelastic supply, enhancing short-term price responsiveness. In addition, logistical challenges, transportation constraints, and warehousing capacities can further influence the speed at which supply meets demand, making the timing of physical delivery decisions increasingly relevant. Behavioral elements also play a role. Historical memory shapes perception. Investors who recall silver's previous periods of stagnation or sudden spikes may anchor their expectations accordingly. This anchoring can influence both the speed of new inflows and the intensity of reactions to technical levels. Observed breakpoints such as recent surpassing of psychological thresholds in the low 90s can trigger cascades of forced activity, short covering, momentum entries, and algorithmic reactions, each amplifying the initial move. Yet, sustaining these moves requires more than mechanical responses. Underlying demand, policy signals, and industrial engagement must remain aligned. Critical minerals policy continues to act as a structural backdrop. The designation of silver as critical in the United States does more than signal strategic importance. It informs investment frameworks, influences corporate procurement, and shapes expectations about government intervention and sourcing. Even delayed tariff implementation carries informational weight. Market participants must interpret these signals in real time, integrating them with observable flows and inventory levels to decide whether to increase holdings, secure physical supply, or hedge exposure through derivatives. The dual role of silver, as both a monetary and industrial metal, creates feedback loops that are less predictable than in other commodities. Industrial users adjust procurement in response to expected prices, while investors adjust holdings in response to policy, geopolitical, and macroeconomic signals. Each group's behavior influences the other, generating multidirectional pressure that can intensify volatility in both directions. The magnitude of these interactions depends on the degree of alignment between investment and industrial pressures at any given moment. Political dynamics remain another layer influencing expectations. Public debates and scrutiny over central bank independence can alter market psychology, even without immediate policy changes. The perception of potential rate cuts or leadership shifts can encourage investment in hard assets because they reduce the opportunity cost of non-yielding instruments. While the precise timing of any policy adjustment is uncertain, the market responds to evolving expectations, demonstrating that perception can drive price movement as much as factual implementation. Pullbacks and consolidation periods provide further analytical insight. When prices retreat following a breakout, observing the volume and speed of these adjustments helps distinguish between a temporary test of breakout levels and a potential failure of the move. If industrial actors and delivery participants maintain engagement during a dip, the underlying story remains intact. Conversely, if physical demand eases and speculative positions unwind, volatility may persist without sustainable support. This distinction is crucial for understanding market resilience in real time. In parallel, the market has been testing new reference points psychologically. Levels that were once considered resistance or support now serve as anchors for the next phase of positioning. Historical price ranges, when broken, require participants to recalibrate mental models. This recalibration process is not instantaneous. It unfolds over several sessions and is influenced by both observed behavior and public information. As the market adjusts, interactions between speculative flows, physical demand, and policy signals create complex, sometimes nonlinear outcomes. Emerging supply constraints can interact with these psychological levels. The combination of limited physical availability and concentrated industrial requirements can cause price sensitivity to increase, particularly when a sufficient number of participants shift from passive to active acquisition. Large-scale deliveries or inventory shifts serve as visible markers of underlying stress, influencing not only price, but also risk assessments and positioning across both regional and global markets. Historical analogies suggest that episodes of simultaneous political uncertainty, critical mineral policy shifts, and heightened industrial demand tend to produce environments where volatility is pronounced, but also where structural support exists underneath price movements. Unlike purely speculative rallies, these situations tend to persist as long as the underlying drivers remain coherent. Observing changes in delivery activity, industrial procurement, and open interest can help differentiate between transient noise and durable structural pressure. Currency fluctuations, geopolitical considerations, and macroeconomic trends continue to interplay with these pressures. Dollar strength or weakness, regional supply risks, and anticipated rate adjustments each interact with both investment and industrial decisions. When combined, these factors produce layered complexity that cannot be captured fully by headline narratives alone. The market is effectively processing multiple, sometimes conflicting signals, creating both opportunity and risk. As silver sits above recent thresholds, these intertwined dynamics remain unresolved. Participation patterns suggest that some actors are reacting strategically to potential long-term shifts, while others respond tactically to short-term movements. This mixture of strategic and tactical behavior contributes to the current volatility and underscores why market analysis must consider both physical and paper markets in tandem. Understanding which participants are active and why illuminates the forces shaping current pricing and potential near-term adjustments. The interaction between industrial demand, political context, and delivery behavior establishes a delicate balance. Any adjustment in one component can propagate through the system, producing outsized reactions relative to the original trigger. Observing these feedback loops, particularly when multiple structural pressures converge, provides a framework for interpreting the current episode and anticipating how subsequent developments may influence positioning, both in physical holdings and in paper contracts. At this stage, silver's dynamics are increasingly shaped by the convergence of structural pressures rather than a single catalyst. Delivery behavior remains a critical signal, and when participants opt for possession over exposure, it compresses near-term supply and reinforces sensitivity to both industrial and investment flows. Observed activity indicates that this preference is extending beyond traditional heavy users, suggesting a broader reassessment of risk and inventory priorities across multiple market segments. The implications are not about predicting a precise level, but understanding that the underlying liquidity landscape has shifted. Macro considerations continue to exert influence. Political uncertainty, rate expectations, and currency movements all interact with industrial demand in ways that can amplify short-term swings. When capital reallocates in response to perceived instability, both physical and paper markets respond, often in different ways. Industrial participants may accelerate procurement or secure forward contracts, while investors may shift portfolios toward hard assets. The interplay between these groups determines whether price action remains contained or cascades through multiple layers of the market. Policy signals, even when delayed or partial, also shape sentiment. Critical mineral designation affects corporate planning and governmental attention, while discussions around trade measures or tariffs introduce potential constraints that participants must incorporate into their risk calculations. Historical precedent shows that markets often price in these signals before any official implementation, which can generate volatility as participants adjust in real time. The result is a layered environment where expectation behavior and availability intersect. The dual role of silver, industrial metal, and monetary asset remains a central feature. Industrial use creates ongoing baseline demand, while investment demand fluctuates with broader perceptions of risk, policy credibility, and macro uncertainty. When these demands align, even partially, volatility can intensify rapidly. Pullbacks and corrections provide important information. They reveal whether underlying participation remains committed or if transient flows dominate the market. Observing follow-through, volume, and delivery trends helps distinguish between temporary testing of levels and genuine structural support. Psychological thresholds continue to guide behavior. Levels that were previously treated as resistance now act as reference points for positioning, stop placement, and momentum triggers. Breaking through these thresholds can accelerate mechanical activities, such as algorithmic execution and options adjustments. However, sustaining such moves depends on the depth of underlying demand, particularly from physical holders and industrial actors who interact with the market for operational rather than speculative reasons. Volatility itself functions as both a signal and a mechanism. Rapid swings highlight sensitivities and expose where structural pressure points exist, particularly in the interaction between industrial procurement cycles and investment flows. The heightened sensitivity above certain price levels reflects not only speculative interest, but also the alignment or misalignment of multiple structural factors: political uncertainty, monetary expectations, critical mineral policy, and the evolving dynamics of physical delivery. Each factor alone can influence behavior, but together they create a more complex, less predictable environment. Currency fluctuations and geopolitical developments continue to layer additional complexity. Even modest shifts in exchange rates or regional risk perceptions can influence cross-border procurement, hedging strategies, and relative attractiveness of holdings. The market processes these signals continuously, adjusting positioning, settlement activity, and hedging tactics accordingly. This interaction illustrates why silver S price movements often appear abrupt. Multiple independent variables converge in narrow windows of observation. Historical context provides perspective. Prior episodes of simultaneous political pressure, elevated geopolitical tension, and evolving industrial demand have produced similar conditions where volatility is amplified, but the underlying story remains intact. Patterns from these periods suggest that price adjustments are often the market sway of reconciling short-term mechanical flows with longer-term structural pressures. Observing delivery behavior, industrial activity, and open interest offers insight into whether current conditions are likely to persist or revert. The behavior of strategic participants offers additional clues. Entities emphasizing physical possession over rolling contracts indicate a desire for certainty and control in an environment where supply perception matters. Even if speculative flows dominate the headline price action, these underlying decisions can create friction points that influence the trajectory of the market beyond what purely technical analysis might suggest. Understanding the interplay between tactical and strategic positioning is crucial for interpreting the current environment. Industrial procurement considerations are especially relevant given silver's critical mineral status. Companies dependent on the metal for manufacturing, energy technology, or electronics must weigh current and anticipated supply conditions against operational timelines. These decisions, while less visible than headline-driven trading, exert real pressure on available inventory and can influence pricing patterns, particularly when multiple participants act concurrently to secure supply. As these factors converge, the distinction between short-term price action and structural market shifts becomes clearer. Volatility remains, but it is contextualized by observable behaviors that point to both stress and adaptation. The interaction of delivery preference, industrial demand, policy signals, and geopolitical awareness forms a framework in which price sensitivity is heightened, creating conditions where even moderate changes in one component can propagate widely. In this environment, understanding risk requires separating transient fluctuations from structural developments. Corrections do not necessarily indicate breakdowns. They often represent recalibrations within a broader context of sustained pressures. Conversely, rapid movements can reveal emerging alignment across multiple forces, suggesting that underlying conditions are reinforcing one another. Monitoring these dynamics provides insight into the durability of price levels and the potential for further market adjustments. Finally, currency, policy, and industrial signals continue to interact with market psychology. As participants recalibrate expectations, the feedback loop between perception and action strengthens. Price levels that were once psychologically significant may now serve as new anchors, guiding future positioning and shaping follow-through. Observed behavior in futures, options, and physical delivery collectively informs the evolving market narrative, illustrating that silver's recent activity reflects a complex interplay of measurable factors rather than a single causal story. In essence, silver's current state is defined by the convergence of multiple interrelated pressures: political uncertainty, monetary policy expectations, geopolitical risk, industrial demand, critical mineral designation, and shifts in physical delivery behavior. Each factor contributes to market sensitivity, influencing volatility, positioning, and the responsiveness of participants across both investment and industrial domains. Understanding these interactions is essential to interpreting price behavior, observing the balance of supply and demand, and anticipating how the market integrates ongoing developments into its evolving structure.